Okay, welcome to the D Knowledge channel. Today we're going to talk about how banks are using certain vehicles, investment vehicles, or entities in order to foreclose or put a foreclosure out on people's homes. We're going to discuss the models that the banks use for homeowners. There's a particular model that they use, and we're going to discuss those models today. Many of the banks, what they're doing, they're taking these promissory notes and they are putting them into what is called an IRC 1031 exchange. And by doing so, the banks are able to put these promissory notes together, put them in a particular investment vehicle or special purpose entity vehicle, and put them on the markets for investors to invest in. At the end of the day, when a homeowner is not able to meet their obligation in regards to the mortgage, the banks are accelerating the loans and taking the homes from the homeowners when in actuality they don't own them in the first place. They have already sold those homes. So we want to discuss how this happens. First of all, we want to understand that the banks are securitizing your promissory note. They're taking promissory notes and they're securitizing them. There's a Glass-Steagall Act, which is also known as the Banking Act of 1933. And it was passed by Congress in 1933, and it prohibited commercial banks from engaging in investment business. Now, this is important because it was enacted as an emergency response to the failure of nearly 5,000 banks during the Great Depression. So during the Great Depression, they enacted this act because they felt that it was important to help the regular people in regards to banking and the things that the banking were doing to make the market crash during that time, and how the regular people got caught in the depression and they were the one to lose everything. So it was enacted to help save people against these different type of banking procedures that these banks use. Bill Clinton, of course, in 1999 signed a legislation reversing and deregulating the consumer credit lending practices. So what he did was he diverted risk from the secondary market, making way for the IRC 1031 exchange on the prime markets with real estate or real property after acquired collaterals such as an electronic channel paper or the promissory note that you use that MERS puts you into. And we'll discuss MERS in a minute. And this is all done under the revised UCC 9. Now we want to talk about how a bank is able to do this. To qualify for Section 1031 of the Internal Revenue Code, because this is what this is under. It's under the 1031 of the Internal Revenue Code. The properties in exchange must be held for the productive use in a trade or a business or for investment. I.e. examples are stocks, bonds, and other properties are listed as expressly excluded by Section 1031. So you can't use stocks or bonds for the purpose of 1031. But you can use, under the Section 1031 of the Internal Revenue Code, through securitized properties, they are not excluded. Securitized properties is what the bank has got the homeowners in. They have taken that promissory note, securitized it, and put it on the stock market. And that's not excluded. The properties in exchange must be of like kind. They must be of the same kind. You can't take personal property and put it together and package it with real property. Or in other words, someone's home. You can't take a car and package it with a house. So these properties in exchange, it must be of like kind. It must be of the same nature and character, even if they differ in grade or quality. Personal property of a class or like kind property personal property and predominantly in the United States, and personal property used for predominantly elsewhere are not kind property. They're not the same type of property, so they can't be used in the package as I discussed before. Some are basically these special purpose vehicles. They have U.S. patents. They're patented by the U.S. in the United States. They have a patent that they have registered with the United States in order to execute this particular scheme that they have going on. The present invention provides systems and methods for carrying out financial transactions, which secure assets and ensure checks and other financial obligations are honored, as well as provide various other advantages. For example, in an exemplary embodiment of the present invention, a system for carrying out a financial transaction comprises of, first of all, it has to be a financial institution which issues a payment obligation, and a special entity which acquires a residual obligation. A residual obligation is something that's continuous, an obligation that's continuous. And reason why it has to be that way is because first, the financial institution has to provide a consistent payment agreement for investors on the market to invest in as they package these things up as a security. By not doing so, they wouldn't want to invest in those things. They need to know that they're going to get a particular sum of money consistently. So the residual obligation after acquired proceeds to an i.e. chattel paper to honor the payment obligation, and the funds from the financial institution to honor that obligation. In accordance with various aspects of the present invention, the special purpose entity is provided with the ability to invest the acquired funds prior to honoring the payment obligation. So what they're doing, the banks, they are getting the money from investors. They're getting the money from investors. This money is used to acquire the home that homeowners are getting. Now, what the bank does is, by already receiving this money from investors, they have them invested in securities already, but they haven't had a certain security that they have set out yet. So what they're doing, they're having homeowners, they're finding homeowners so they can honor the obligation that they have to investors. And this is why the market, it was the way it was in 2007. This is why everyone and everything fell when the housing market fell. And that's because everybody's invested in them. A whole market is invested in these real estate promissory notes because they're packaged up, they're put on the market through a trust under Lord knows what, and investors are investing in them on the market as a trust. They're invested in them as REITs, and they're invested in them as different things that that investors would like to invest in and get a return on their money. And this is why everyone was affected, because everyone is invested in them. And if it happened before, and it's still happening. So many homeowners lost their home, and many people don't know why. Many people don't know why they lost their 401k. There are so many different reasons, and this is why we would like to bring the knowledge to you guys, so you guys can do the research, look at these things yourself. And we're going to point out a couple of them here momentarily. Actually, I do have here available for you. We want to take a look at this. This is a US patent. And we're going to open this up so you guys can see this. This is U.S. Patent 200301 0571 3A1. All you have to do is put in a Google search US 200301 0571 3A1, and it will bring up this patent for a special purpose entity for holders of financial instruments. This patent explains a lot of what's happening out here now. And it explains how these vehicles are ran, basically how this vehicle is operated. And I'll explain some of the abstract of the special purpose vehicle classifications and what it does. The present invention provides systems and methods for carrying out financial transactions, which protect assets and provide various other advantages comprising of a financial institution which issues a payment obligation, a special purpose entity which acquires a residual obligation to honor that payment obligation, as well as funds from financial institutions to honor the obligation. In accordance with various aspects of the present invention, the special purpose entity invests the acquired funds prior to honoring the payment obligation, as we discussed.